Hello and welcome to the latest Expert Series webinar. Today's webinar is MLP Taxation, Know Your Options. This is a complimentary ETF.com webinar courtesy of Global X. I'm Ollie Ludwig, the managing editor of ETF.com. We are the leading authority on news and data about ETFs and the company behind Inside ETFs, the world's biggest ETF conference. Joining me today are Greg King. Greg is the Executive Vice President for Global X Funds. He's in charge of product development, and he works with the Global X team to bring products to market. Greg also has a past at Credit Suisse and Velocity Shares, so he has expertise in the ETN space as well. Additionally, we have with us today Rob Velotta. He is a tax partner at Cohen Fund Audit Services. He specializes in providing all kinds of compliance and consulting services to its client base of mutual funds, hedge funds, ETFs, private equity funds, family limited partnerships, and also advisors to these various funds. So everyone knows you can ask questions at any time during the webinar in the window at the lower right of your screens. I also may be asking Greg and Rob a few questions along the way, but we will have an audience Q&A after the presentation, so please ask questions in that lower right window. This is a great topic. The financial repression since the crash of 2008 remains with us, and the ECB's latest move today, cutting rates yet again, makes clear that low bond yields are possibly here to stay for quite a while. Faced with these challenges, advisors have been looking around the investment landscape for income-producing investments to better serve their clients, particularly considering the building waves of retiring baby boomers who need respectable fixed income streams to meet their retirement needs. 10-year treasuries, which ended the year at 3, are much lower now in the neighborhood of about 2.35%. In this environment, a variety of unexplored investments or underexplored investments have become quite popular, even trendy, and that includes high-yield debt, emerging markets, credits, dividend-paying stocks, and on the more exotic side, bank loans with floating rates. Now, among these choices of possible income generators is one investment class that has really captured the imaginations of investors, master limited partnerships, or MLPs. They've become so in, if for no other reason that they really are shooting off some really great yields, often in the 5 to 6% range. Their growing popularity has also much to do with the emergence of ETFs and ETNs in recent years, which in a general sense have democratized access to segments of the investment universe that in ways that were previously pretty much unimaginable. As things stand today, there are 23 U.S.-listed exchange-traded products on the market with a total of almost $21 billion in assets under management. 10 of these products have at least $100 million in assets, and a few of these products have billions in assets, which speaks to the fact that in some ways MLPs are all the rage. We're really focusing in on about 3 securities today from Global X, the Global X MLP, which has a asset base of $131 million. Its junior partner, the Global X Junior MLP, has about $19 million in assets under management. And finally, last but not least, the Global X MLP and Energy Infrastructure ETF, which has $185 million in assets under management. In all this craze about MLPs, there may well be a catch, and that catch is tax-related treatment. It hardly seems an exaggeration that many investors might be hard-pressed to really grasp what all the tax implications are. And regarding ETPs, do investors want their MLPs served up in an ETF or an ETN or in a 40 Act structure? And all have different tax implications. And while we're at it, they want an active or a passive wrapper. Luckily, we have a couple experts with us for the next hour to help us navigate these complex MLP straits. One of them is a tax expert. So let's get into it with Greg King of Global X and Rob Velotta. Take it away.
Thanks, Ollie. Hi, everyone. This is Greg King. I'm Executive Vice President at Global X, Head of Product Development, as Ollie mentioned. And we are definitely excited to bring you a tax expert this afternoon, I guess if you're on the East Coast, and morning on the West. That person is decidedly not me. It is Rob Velotta, and he'll be coming up here in just a few minutes. I wanted to talk about briefly the MLP sector and just start off by telling you our goal for this presentation is really to just add value to your investment process. So we're hoping to bring you some information in this kind of arcane world of the taxation of MLPs and investable MLP products that somehow helps you navigate the space, whether it's for yourself or for your clients. We'd of course love it if you check out our website and so forth, but the purpose of this presentation is to really kind of offer the services of an expert in the space and allow plenty of time for Q&A afterwards. So here's how we're going to proceed. I'm going to give you a quick overview of the investable world in MLPs, and then we're going to dedicate the bulk of the time to Rob's presentation, where he's going to take us through various product types and address their tax characteristics. So, first off, what are MLPs? We figured that most people on this call know what an MLP is, but very briefly, it's a master limited partnership, and essentially it's a pass-through tax structure. Now, why do investors like them? I think there are two reasons for this. Number one, and this applies more to the midstream MLP sector than perhaps some of the others, but they fundamentally operate like toll roads. They consistently have revenues regardless of the price of energy, oil, and gas. And so their revenues are more consistent, less volatile, and that income is able to be distributed in a tax-advantaged way. So that's the second reason people like MLPs. You can see in this graph here the growth of the market capitalization of energy-related MLPs in the last 12 years. The graph doesn't show you, but in 2014 we're already up to $550 billion in terms of market cap, and if you just ballpark that, that's a 20 times increase in the market cap of these MLPs over the last 12, 13 years. So you can see the amount of dollars that's flowing into those. The second graph here is a pie chart, and it just kind of illustrates the point that a lot of this market cap resides in the midstream MLPs, and that really goes to the toll road aspect. These are the guys operating pipes, and the explorers are finding the resources and passing them through the midstream pipes, and then they're going down into the downstream production processes. Flipping forward, we have a chart that essentially gives us a roadmap of what we're going to cover. Direct investment is obviously the main way that people access MLPs, but there's a problem that Ollie alluded to there. The K1 issue is primarily the constraint that most people have. And of course, Rob will get into this in more detail, but you do have situations where MLPs are taking pipes through 20, 30, 40, even apparently there's one MLP that goes through 50 different states, and so you have potential tax situations that need to be considered in each of those states. So this has given rise to really a growth of packaged products and ways to access MLPs that don't rely on direct ownership but indirect ownership. And so what we're going to cover is really the four main vehicles in the funds and exchange-traded product space. Of course, you have ETFs, closed-end funds, open-end mutual funds, and exchange-traded notes. You can see there at the bottom of the slide the two boxes. We have grouped the funds, that's everything except the exchange-traded notes, into two subcategories, one labeled CCorp, one labeled Ric. And Ric just means Registered Investment Company or Traditional Mutual Fund. And what you need to know there, which of course Rob will mention in more detail, is that those funds are only allowed up to 25% exposure in MLPs. Now, once they cross that,
Greg, can I chime in really quick here? I wanted to clarify that one of the ETFs that you guys have on the market, MLPX, is a Ric, right? And it's not a pure MLP ETP, right?
Yes. Yeah, that's right, Ollie. Thank you.
Good. All right. Thanks. Sorry for the interruption. Do you want to make that clear?
Yeah. No problem. So some of these are RICs, and that means that they don't invest more than 25% in MLPs. Some are not. That means they have no longer qualified as mutual funds, and they are corporations, which essentially gives them a double layer of tax. Let me flip this slide here. Just want to run through some basic stats in each of these product categories. So mutual funds, you can see there are 19 of them, about $23 billion in assets. These are actively managed products in general, and the average fee is 1.5% or so. I think the key takeaway here is you want to be aware of whether your product is a traditional fund or a C-Corp, and there are both kinds out there. The closed-end fund space, you have 27 products and $33 billion in assets. Really, this is a leveraged play on the MLP sector. All of these funds operate with leverage. You can see the fees are substantially higher at over 2%. And so generally, people who are looking for leverage are using these products. Flipping forward to the exchange traded products that we all know and love, you can see you have, as Ollie sort of mentioned, 10 billion roughly in ETFs and 11 billion in ETNs, which is a kind of a curious situation in that the ETN market is typically much smaller than the ETF market, except for the MLP sector. And the reason for that is, of course, taxation. The fees are a little bit higher in ETNs than ETFs, but that interest is driven by taxation. Key takeaways here on the ETF side, again, you want to monitor and understand whether you have a traditional fund type of structure or a C-Corp structure. And as Ollie mentioned, we actually have both types of funds available. On the ETN side, as most everybody knows, the thing you want to be wary of is credit risk, and you want to make sure you're comfortable with the issuing bank if you do own an ETN. Finally, just a little growth slide here. The point of this one is you could see in 2009 you had one ETN out there tracking the space with not a lot of assets. That ETN grew in size and in terms of both number of ETNs and assets under management, and along came the first ETF in 2010. That grew in size and assets under management, and in 2012 you got the first ETF that was a RIC ETF, so a traditional fund-based ETF. So the evolution here is the point. You had the ETNs as an access point, then you had the ETFs that were structured as C-Corps, and now what you're seeing is RIC-compliant ETFs that are growing. Finally, we just have a little cheat sheet here for you. It's pretty straightforward. May want to refer to it after the presentation, after Rob gets through some of his content. And again, we're not trying to advise anyone in any way. We just want you to understand a bit more about the taxation of MLPs and the investable products and help you to make better decisions for your clients. So let me turn it over to Rob, who has promised us a riveting tax presentation. Rob?
Thank you, Greg. By way of background, I think it's important to understand the traditional way that individuals got exposure to MLPs and a little bit of history around the MLPs. MLPs in their current form really started in 1986. In 1986, there was a tax act that allowed for the creation of certain public entities, specific to oil and gas and similar type entities that were allowed to be taxed as a partnership but be traded on a public exchange. What we're going to talk about today is how that origin of those MLPs have turned into products that have come out to the market. The slide that you're looking at here is really going to be the overview of the various items that we're going to be talking about. Pretty much everything going on from the rest of this presentation is going to be expanding upon these various areas here. Going forward, we're going to really be putting those first three buckets together. The mutual fund, closed-end fund, and ETF. I'm going to go ahead and consider those all as MLP C Corporation funds, and we'll go in and describe that in a lot of detail. But those three items we're going to group together because from a tax perspective, they really look and smell and act the same way. We're going to talk about the RIC funds, and again, Greg gave a quick overview, and we're going to talk about exchange traded notes. So what exactly is an MLP? Greg has already talked about an MLP from a investment perspective. I'm going to give you some tax code around an MLP. Specifically, an MLP, and their tax code is never defined. Instead, it's defined as a publicly traded partnership, and specifically limited partnerships that are traded on stock exchanges that operate in specific active businesses. Generally, they're going to be energy or natural resource related. So the code section that covers this kind of investment is Section 7704 of the tax code. And what that says is, if you're a publicly traded partnership, your general rule is that you're going to be taxed as a corporation and treated just like every other stock that's publicly traded. The exception to that is, if you meet these criteria, even though you're a publicly traded entity, this partnership is able to be taxed as a partnership for all the good and bad and ugly that may be there. So what kind of investments are able to be taxed as a partnership? What kind of activities? The partnership must have at least 90% of its income that's generated from interest, dividends, real property rents, and that fourth bullet point is really the most relevant here for MLPs. Exploration, development, mining or production, processing, refining, transportation, or marketing of any mineral or natural resource, or transportation or storage of fuels. So in particular, that's the MLP marketplace as you traditionally know it. That's how MLPs are able to be taxed as partnerships from a tax perspective. What's important to note is most MLPs or most publicly traded partnerships are energy related. There are some other partnerships that are out there that are publicly traded that meet these definitions. One of the most common examples is Blackstone Group. Blackstone is structured as a partnership and has been able to structure their activities that they meet the definition. But for purposes of the remaining of this discussion, we're really going to refer to MLPs or publicly traded partnerships as focusing on the energy sector. What's also important to really understand here is people use the term MLP as an investment wrapper and again not a tax wrapper. So there's many things that are not a partnership from a tax perspective but are thrown into the MLP bucket. The two most common examples would be related to the general partner of an MLP or some offshore shipping companies. For example, we'll talk about Kinder Morgan a little bit later, but Kinder Morgan Management is often referred to as an MLP. While in actuality, it's not a partnership. It's a corporation that is serving as a general partner of the underlying MLP or partnership. So it is a corporation. And again, there's offshore drilling companies or offshore shipping companies that, even though they may come to events like the National Association of Publicly Traded Partnership events, may be referred to as MLPs and be part of the energy business, are actually taxed as corporations. So for purposes of this discussion, we're really going to talk about MLPs, again, focusing on energy. So again, what are some fundamental differences between MLPs and corporate stock? Clearly from a label perspective, partnerships don't have shares. Instead, they're commonly referred to as units of the MLP, as opposed to a corporate stock which issues shares. The biggest issue you see with respect to the differences between a partnership and investment in a corporate stock is the pass-through of attributes. So when you're investing in a partnership, you don't get a dividend. Instead, you get a pro rata share of the underlying business activities of that partnership. And how is that reported to you? It's reported to you via K-1. So the distributions that are paid to you are not dividends. They're really a return on that investment from a tax perspective. Compare that to a corporate stock. A corporate stock pays dividends on its earnings. It's going to be taxable to the investors as a dividend, and you don't get a K-1. Instead, it's going to be reported to you as a 1099, and that's how much income you're going to report on your returns. How about from a disposition of the activity or disposition of the investment? A corporate stock, as everybody knows, you're going to have capital gain. You're going to sell a stock and recognize capital gain on the disposition. In the MLP space, you're going to be deemed to be disposing of the underlying assets held by the partnership. So what does that mean? That means if the underlying partnership has depreciable assets, some of that income or some of that gain on the sale of that partnership may not be capital gain. It may be ordinary. And if you invest in MLPs, you'll see that on the K-1. Again, one of the biggest fundamental differences between partnerships and corporate stocks relate to this blocker concept. A corporation is its own taxpayer. A corporation effectively blocks all types of activities from having to be dealt with at the individual level. Things like state tax filings. We'll talk about state taxes and how many MLPs are doing business in multiple states. Well, if you're an individual investor in an MLP, that you are receiving a K-1, you may have tax filing requirements on all of these states. Whereas a corporation, all of that is dealt with at the corporate level. So there is no flow through of that. Similarly, for IRA, pension, foundation investors, there's a concept called unrelated business taxable income, whereby these IRAs or pensions or 401k plans may have to pay tax. Well, if you have an MLP investment, that's a situation where those type of entities, even though they're tax exempt, may have to pay tax, whereas a corporate stock blocks those attributes from coming through. So again, fundamentally different. So why are we talking about MLPs and MLP funds, and why are they so different from other types of mutual funds, exchange-traded funds, or other kind of funds that are out there? Really, it comes down to this. A regulated investment company, again, I'll refer to that as a traditional fund, a traditional ETF, traditional mutual fund. In a regulated investment company, or RIC, those entities don't pay any tax. There's a concept called the dividends paid deduction, which means to the extent that the underlying fund earns money, has taxable income, to the extent it distributes that income to its investors who pay tax, that fund doesn't have to pay any tax. How does that apply in the MLP context? Well, in the MLP context, really what we're focused on is that a regulated investment company can't have all of its investments in MLPs. Prior to 2004, really no fund invested in MLPs because you really couldn't. And that changed under the American Jobs Act of 2004. So what happened there is Congress allowed mutual funds to invest in publicly traded partnerships, but said, we're very concerned about tax-exempt investors or non-U.S. investors investing in these products, so we're going to let these investments be part of the regular investment company structure, but you're limited to only investing up to 25% of your fund in qualified publicly traded partnerships. So it puts a severe limit on a traditional fund being having 100% MLP exposure. So again, in summary, a mutual fund, ETF, closed-end fund that has 100% exposure to MLPs can't qualify for that flow-through treatment, and it has to find some other way to structure their investment to go out to the market. So this is where the CCorp funds have come into play. The C Corporation funds are different from your traditional fund in that they actually have a tax. There actually is a tax drag associated with that. And we'll go through the mechanics of that in a minute. What's important to note, again, with all of these investments, the purpose of this webinar is to really discuss the differences from a tax perspective and allow the investors to make that decision of what's best for them. So the C Corporation fund, the primary downside here is that corporation accrues a corporate tax. If the fund invests in MLPs and the investments go up by 10%, the fund's net asset value isn't going to go up by 10%. It's going to go up by 10% less some reduction that is because of the corporation having to pay tax on that gain at some point. Again, what's the benefit here? There's no K-1s. There's going to be 1099 reporting. And that's been one of the primary draws that you found with these funds, aside from a diversified portfolio and ease of investment. The blocking of that K-1 reporting has really been a huge benefit. So again, it blocks unrelated business taxable income, and basically the fund is going to address all the state tax compliance that you might otherwise have to have at an individual level. One of the downsides to a corporation is a corporation doesn't have capital gains tax rates. So unlike an individual who could pay capital gains rates at 15%, 20%, 23.8%, a corporation, capital gains is just treated as income. It's treated as income and taxed at the same rate, up to 35%, that any other income of the corporation earns. So how about the distributions that come out of these MLP funds? Well, distributions from these corporations are going to be dividend income to the extent of earnings and profits. It's going to be treated just like any other public company. it's going to come up with its earnings and profits calculations, which is a tax-defined term, and to the extent that the fund pays distributions that come from those earnings, they're going to be taxable as dividends to investors. To the extent that those distributions are not from earnings and profits, which, for most cases is basically taxable income of the fund, then those distributions are going to be considered to be return of capital to investors. So currently non-taxable and reduce the investor's basis in the fund. What's a very important distinction here with CCorp funds versus some regular investment company funds that we'll talk about later is that the dividends coming out of these CCorp funds may be eligible for reduced capital gain or reduced dividend rates or considered qualified dividends, which means they could be taxed at capital gains rates. This next slide really describes the C Corporation fund performance. Again, it is intending to really describe this tax drag that has gotten a lot of press relative to the C Corp funds. So in example 1, the underlying assets of the fund increased by 10%. So the fund, based upon its calculations and estimates of tax, are saying that they will be paying tax on 37% on that gain at some point. So the investor's increase in value, the investor's increase in share price is only 6.3%. So again, that's the tax drag relative to the C Corporation funds. Look at example 2. Example 2 is pretty much on the contrary, on the downside. Underlying assets of the fund, underlying investments in the MLPs, decreased by 10%. So in this case, an investor's performance doesn't necessarily go down by 10%. Instead, the investors are going to get a tax benefit equal to the amount of tax that the corporation won't have to pay because the investments went down in value. So the investor's decrease in value is 6.3%. Now, there are some cases where that's not going to be always true, related to valuation allowances, but for the most part, that's your tax drag, and that's the example that you really want to understand here, is that on the upside, there's going to be tax effect, and in most circumstances, on the downside, there's going to be a tax benefit relative to that loss. At this point, I guess I wanted to send a quick reminder that in the bottom right is a Q&A section. To the extent that you did have questions, we will intend to incorporate the rest of that in the discussion, but there will also be a Q&A section, so I will encourage you to ask those questions. The second major investment that we want to talk about today are Ric MLP Funds. Again, ETFs, mutual funds, closed-end funds. From a tax perspective, I'm going to group them all together and treat them as one. The primary difference here from a Ric fund, a fund that doesn't pay tax, or a traditional fund, is that only 25% of its assets can be invested in publicly traded partnerships, or MLPs. So what does the fund do with the rest of the 75%? It's going to invest in other things. Maybe they're C Corporation general partners. Maybe they're other energy or infrastructure related companies. Maybe there's some of these offshore shipping companies that are taxed as corporations. They're going to invest something else. They're going to invest the majority of their assets in something else other than partnerships, but tend to still be energy and infrastructure related. Like an individual taxpayer, these Ric funds are going to be subject to passive activity limitations. What that means is that the fund is going to have potentially some losses that are suspended related to the activities, related to the losses that may flow through from these underlying MLPs. So something that differs from our C Corporation funds. What's also a big difference here is, as opposed to the C Corporation funds that can't pay long-term capital gain distributions, the Ric MLP funds do. So from a Ric MLP fund, you can have three types of distributions. You could have ordinary distributions, which notably, in many cases, some of them will not be taxed as qualified dividends. So you can have ordinary dividends. You're going to have long-term capital gain dividends, and then you could still have return of capital based upon the investments. Whereas in a C Corporation fund, you can only have two types of distributions. You have qualified dividend distributions, and you have return of capital distributions. So similar to the Ric funds, there's a or similar to the C corporation funds, Ric MLP funds can block unrelated business income tax and state tax compliance. So those issues are really related to being taxed as a corporation. So one of the questions that have come through from many people on the webinar today is, can you describe unrelated business taxable income and what exactly that means? And I think now is probably an apropos time to talk about it. So unrelated business taxable income is a tax by which tax-exempt or tax-deferred investors may have to pay. If you think about historically, the intention is so that a not-for-profit entity doesn't go out and invest in operating businesses and have a substantial competitive advantage versus taxable entities. So in order to alleviate that concern, Congress put in place this concept called unrelated business taxable income, which then correspondingly is unrelated business income tax. How it applies here is if you have an IRA that invests in MLPs, the MLPs are active businesses. And because they're active businesses, to the extent that an MLP or an IRA is invested in these MLPs, it may have to pay tax on any income that is generated by those by the underlying MLPs. And that tax is 35%, so it's taxed like a corporation. So, it tends to be quite complicated, and I think it's something that we can spend a tremendous amount of time on. But, in summary, it's really a tax that IRAs may have to pay relating to investing in flow-throughs that have operating businesses. So again, the C corporation funds and the Ric MLP funds effectively alleviate that concern for investors, for IRA investors. Here's an important but very quick slide that I think really differentiates the difference between a C corporation fund and a Ric fund. A Ric fund is a flow-through entity that pays no tax, but invests more than 75% of its assets in corporations that do pay tax. So again, it's a flow-through, but invests in things that pay tax. Compare that to a C corporation MLP fund, will pay tax at the corporate level, but invest primarily in partnerships that don't pay tax. So again, a very fundamental difference between the two investments. The next topic that we want to talk about is MLP exchange traded notes. So there's obviously a big amount of, when you look at the C corporation funds, you have this tax drag. And then you have the investment in the regulated investment companies, and they're not pure play MLP investments. They're investments in infrastructure. So how about if we come up with a type of product that gets you a pure play MLP investment, but doesn't have the tax drag of the MLP C corporation. And that's where the MLP ETNs really come into play. So we're going to talk very quickly about the structure of these, and that there's no assets that are actually attached to these exchange traded notes. As most people know, they're debt. They're debt instruments issued by a bank primarily, and the investor doesn't own anything, but a promise to pay by that bank. And that promise to pay is a payment based upon the performance of the underlying index, or in this case, the underlying MLPs. So it is subject to that counterparty risk of the bank. Again, it's an unsecured debt in most cases by a bank. So what's really relevant here? And that's how
Rob, can I interject one quick question here?
Absolutely.
With regards to the ETN? Apart from the credit risk, which you identified very prominently there, which is crucial, the actual ETN, it doesn't actually hold, or it doesn't need to hold, these underlying assets, whether they're MLPs or what have you, right? As long as it delivers that return stream, that's the legal obligation of the ETN, right? So we don't necessarily know exactly what they're owning. Is that fair, or is that a little bit extreme in an interpretation?
No, you're absolutely right. So the bank or the issuer of the note, they really have that downside exposure in this case relative to the investment, but they don't necessarily own the investment themselves. They have a promise to pay. Now, from a practical perspective, they may go out and hedge it and have other ways that they've mitigated their risk, but there's no actual physical ownership of assets that the investors will have relative to this. and the bank may or may not actually own the MLP investments that the exchange-traded note is pegged to. Correct.
Thank you.
So the taxability of these kind of instruments are really dealing with, really laid out in the prospectus filings. The prospectus filings basically go through and say how you as a investor in the exchange-traded note agree to be taxed on. The service, the IRS has never really formally ruled on the tax structure, although there are similar type of contracts that they're looking at. But you're really going to be bound by this prospectus whereby an investor is going to agree to certain taxability. In these prospectus filings, the first thing that's agreed upon is that the holders or the investors of the exchange-traded note is going to treat any coupon payments as ordinary income, basically as interest income. So not eligible for qualified dividend rates. It's going to be taxed at up to 39.6% plus subject to Medicare surcharge, and it's going to be taxed as ordinary income. And then the prospectus also say, well, what happens when you get out of this? Well, they're saying that, well, because these are a prepaid forward contract, you're going to get capital gain when you dispose of this. There are some discussions, and the House Ways and Means Committee has put forth some filings with respect to derivatives and taxability derivatives, but none of them have happened to date. That may change this tax treatment, but as we sit today, you as an investor get ordinary income treatment on your coupons, and then you're going to have capital gain upon the disposition. What's important to note is, read the disclosures in the prospectus, and what you'll find in these disclosures is they exclude certain things. They'll exclude tax-exempt investors like IRAs, and specifically out of the U.S. federal income tax consequences for this, because they don't really want to get into things like the unrelated business income tax, and that's what this constructive ownership rule may apply. They specifically exclude certain investors from this. ETNs also, in some cases, may trade at premiums or discounts. They're going to be subject to the close provisions that the bank may say, we don't want to issue any more units of this underlying exchange-traded note, which may cause the market to trade at premiums or discounts. So, again, a fundamentally different investment than an exchange-traded fund, but is important and is very widely held. I think the most, the largest one out there is the J.P. Morgan Alerian exchange-traded note, and that is the largest one that's out there. And again, a couple of years ago, it did close creations. And I think while it's out of the situation now, I think it did at some point have a premium. The next slide, I think, is really relevant in that it's intending to go through the individual investor experience of investing in these various products. So taking aside the differences of the investment product, it's intended to really show a couple examples around what happens if you invest in these various products. So some of the assumptions here are that the MLP yield in all of these cases are going to be 6%. So the fund is going to receive 6% yield. The exception to that, we had the Ric ETF is assuming a lower yield of 2.5% under the premise that the MLP investments are a lot lower, so the yield may be decreased. What's important to see here is, we'll go through a couple examples. First one is, well, what happens if there's absolutely no capital appreciation in the investments? Instead, there's 6% yield, but the MLP stock price didn't go up. What's the after-tax return? So the after-tax return here we're talking about is actually saying, okay, what happens if you actually sold it? So accruing a tax at your personal level, assuming a capital gains rate. In this case, the yield is 6%, no capital appreciation. The C corporation's after-tax return is 3%. Again, we're assuming that the fund is going to pay a tax rate of 37.4, so we'll decrease the net asset value. But then as an individual investor, if you were to sell that investment after that year, because you had return of capital distributions, you're going to pay a capital gain tax. So the net return is about 3%. You compare that to the Ric ETF. In this case, again, assuming that there's a much lower yield, the fund is going to get about a 1.7, the investor will have about a 1.7 after-tax return. compare that to the exchange-traded note, which gets about a 3.6% return after factoring in the ordinary income distributions that come out of the MLP yield. Again, what's important to note is this is not net of actual tax dollars that you may have spent. It's net of tax dollars that may be spent at some future point. So, the next example is, okay, what happens if there's a capital appreciation? In this case, you see that, again, the CCorp's after-tax return is about 6%. The ETF's after-tax return is about 6.5%, again, assuming that lower yield. And the exchange-traded note has an 8.4% increase in value, again, after tax. We'll skip example 3 and go to example 4. Example 4 is what happens if there's a market downturn relative to these investments. In this case, what you'll see is the C Corporation wins. Again, we talked about how the C Corporation is going to have some downside protection or reduced risk on the downside because of the tax benefit that'll come in. So in this case, if the MLP yield was 6% and the depreciation of the assets was 6% after tax return for C Corp investors, 0, the Ric product has a downturn, and then the exchange-traded note is also on the downside relative to the C Corp investment. So in this case, the last thing that we're going to really talk about here is Kinder Morgan. Kinder Morgan really provided a lot of exposure to the MLPs, to the MLP section, or to the to the MLP investments and the MLP marketplace, and it's something that I believe all of my clients that are running various funds in the space have gotten questions from investors. So I thought it'd be a very relevant discussion to deal with this situation. So from a big picture perspective, what Kinder Morgan had under its umbrella were 4 publicly traded entities. 2 of those publicly traded entities, Kinder Morgan Energy Partners and El Paso Pipeline, so KMP and EPB, were both MLPs. They were publicly traded partnerships. They also had 2 corporation investments, Kinder Morgan Inc. and Kinder Morgan Management LLC, KMI and KMR, both of which were C corporations. KMI served as the general partner of the MLPs, and KMR was a corporation that had limited partnership ownership of the underlying MLP. So what's happening in this transaction? Effectively, Kinder Morgan is taking 4 entities and turning it into one. They are KMI, Kinder Morgan Management, is going to acquire all the outstanding units of the 2 MLPs and all the outstanding shares of KMR. So what does that mean? We'll start with the KMR side, which is one of the smallest pieces of it. Because of the way the deal is structured, where it's going to be owners of KMR are receiving shares of KMI, the transaction is actually going to be a non-taxable event, or expected to be a non-taxable event to the shareholders of KMR. Well, what happens with respect to the MLP holders, the investors in KMP and El Paso? Well, in that case, the transaction is expected to be taxable. Effectively, it's not a situation where it's going to be a tax-free transaction. So investors that have held Kinder Morgan, for example, for many years are faced with a pretty large tax liability associated with this transaction. This transaction is expected, has been announced to be expected to close in 2014, so in the 4th quarter of this year. So there's been some discussion around longtime direct holders of Kinder Morgan that quite frankly expected to die holding the units and not pay tax on that because they would get a step up in basis at their death. But there is a pretty large premium that's being paid by this. So one of the questions that we've been receiving quite regularly is, all right, this transaction, what impact does this have to my mutual fund, to my fund? I have a C corporation fund. What happens here? Is this going to be a big tax hit? Is this going to decrease my net asset value? What impact is this going to have to me as a shareholder in the funds? Quite frankly, from a net asset perspective, it's going to have none. And the reason why it's going to have no impact is that the funds already are accruing tax throughout the life cycle of the fund on both unrealized and realized gains. So going back to that example that we had where the fund went up by 10%, it put a tax on the books. It put a tax on the books relative to some tax payments that it's going to make in a future point in time. Well, what this happened as part of this transaction is it said, theoretically, some of those tax payments we may pay in some future period of time may be paid today, but it doesn't have any impact on that, on the fund and investors' net asset value in the fund. Instead, it's going to just have an impact on potentially, and I'm going to emphasize potentially, the amount of tax that the fund may currently pay, and that's dependent on a lot of factors. The other thing that it may have an impact on investors is how much of the distributions that the fund is paying to the investors, it may change. And depending on a variety of situations, it may cause a situation where a little bit more of the distributions paid by the fund to investors may be taxable currently as a dividend as opposed to a return of capital. But again, that takes into account a variety of factors. So, one of the things that, has been, asked, quite frankly, is, this transaction, is this going to cause my investment in the fund to go down in value? And to the extent that the fund is appropriately accruing a tax, the answer is no. With that, that really concludes the presentation that I wanted to cover with respect to tax. And Ali, I guess I'll turn it over to you for any Q&A that might have come through.
That's great. Thank you very much, Rob, and thank you, Greg. We certainly have a lot of interesting questions coming in, so let's get right into it. You actually answered a question I wanted to ask there with regards to what happens when an MLP CCorp pays tax. You answered that a moment ago, including addressing the Kinder Morgan deal applications. I suppose I'd be remiss not to ask this, but I presume with Kinder Morgan restructuring that it will affect some of the holdings of some of these ETFs, even though we can't quite predict exactly how. That's probably the answer is a yes there, isn't it? The question is, what's the significance of it? Is that fair, Greg or Rob?
I'm going to answer by saying I don't know. I mean, yeah. and Greg probably answered that, as well. But I think that there's a lot of discussion around the MLP structure. There's discussions around, will other funds copycat, or will other MLPs do a similar transaction? What does this mean to the overall MLPs, marketplace? So I think it's put a spotlight on it. How the investment industry reacts to it, I guess, from my perspective, is really uncertain at this point.
Got it. I wanted to add to the audience that Justin Young of Global X is head of capital markets there. He's also available to answer questions. So if you have some very specific questions that are germane to Global X and its offerings, Justin is also available to answer questions. This is a recurring theme that came through in the questions that came in from the audience. For tax-exempt investors investing in MLPs, there's an understanding that UBTI may be applicable. Can you elaborate on that, please?
Sure.
I presume that's a Rob question, right?
Probably. So with respect to direct holdings in MLPs, again, to the extent that a tax-exempt or an IRA investor, I'll use that example, is investing in MLPs, the IRA investor needs to look at whether or not that activity of the underlying MLP is generating unrelated business income tax. Some of that's disclosed on the K-1, and then, quite frankly, the IRS hasn't provided a lot of clarity around, disposition activities. But so the IRA investor would have to look at the K-1 and underlying activities of that MLP. And if you read a lot of literature around the MLP direct investments, that's a big concern, is that there's an amount of uncertainty here. And while most of these K-1s are generating to date losses because of things like accelerated depreciation and significant investments in infrastructure, that may turn at some point in time and may become a bigger issue to investors. But it really comes down to the IRA would have to look at, is that partnership generating unrelated business income from its operations? And what does that mean for me having to file a Form 990T and potentially paying tax on that income? Whereas an IRA generally doesn't pay tax. So it's a big change in mindset.
Right. There are variations on this question as to which vehicle is appropriate for for which kind of investment, ETN, ETF, in a qualified, non-qualified kind of scenario. We have one question from an individual investor who's looking into open-end mutual fund MLPs. That would be one of the three categories you delineated, Rob. And now, are there any tax reasons to not invest it through a Roth IRA or 401k? If so, explain the tax advantage of a non-tax sheltered investment, please.
So for an individual investor, I think the primary benefit, again, I'll just say fundamentally it's a different investment. In a Ric product and Ric MLP product, which I think was the question, really the fund is investing. It's like any other fund that's out there. It doesn't pay tax, and it's investing in stocks. So again, there is some MLP exposure, up to 25% direct partnership exposure, but could have the other 75% invested in anything. And in that case, it's treated just like any other investment in any other fund. The capital appreciation will be capital gain. The distributions could be ordinary or long-term capital gain. So I think that answers the question, Ali. I guess I'm not sure if I need to go deeper in that.
Yeah, for now that's good. If you guys are willing to do follow-up questions from some of the audience
Absolutely.
members, I'm sure that would be greatly appreciated, because there are a lot of questions here, a lot of good questions, and I'm afraid we are going to leave a few on the table here. Some curiosity was definitely piqued when you touched upon the possibility of having to fill out K-1s in multiple states. Can you please review the situations where MLP ownership could trigger the owner to file a state tax return in each state the MLP does business in, please?
Sure. So the unfortunate answer is there's 50 states with 50 separate rules. Most of the states have certain de minimis filing requirements that say you only have a filing requirement in this state if you have a certain amount of income in that state. But unfortunately, the answer is very facts and circumstances around, do you have enough of activity? So starting with the K-1s themselves, given that there's losses that have been mostly generated by most of these MLPs, there often isn't a lot of immediate exposure. The major uncertainty, then I'll touch on both on the unrelated business income tax side as well as on the individual tax, state tax side, is what happens when you sell these MLPs. From a technical perspective, there are various states that say when you sell a partnership interest, we want some of that gain because you're selling assets that generate losses in my state. I want gain on the assets that are in my state. So, the long and short of it, Ali, is it's really very facts and circumstances, and unfortunately, very, very taxpayer specific. But I think the disposition side and the question around the how states may look at sourcing a disposition of an MLP is really where I think the biggest exposure may be for an individual taxpayer.
Thank you, Rob. Some of these questions here are very, very granular, and I'm glad you're here, Rob. Here's a good one. After a return of capital has been exhausted, the basis has been depleted to zero. Mm-hmm. How is return of capital treated for taxation?
Once you're out of basis, and this is the case for both an investment in a partnership as well as an investment in a corporation, any distributions in excess of basis are treated as if you sold that asset. They're treated as capital gain transactions. So in most cases, you're going to have it long-term before you get there. So distributions in excess of basis wind up being long-term capital gain in most cases.
Thank you. On the flip side of an individual investor, we have a question here. As a trustee, we are generally avoiding direct exposure to MLPs within charitable remainder trusts due to flow-through of UBTI and the probability of a CRT losing its tax-exempt status. The question then is, are we avoiding UBTI through a MLP ETF and able to keep the tax-exempt status of a CRT?
Generally speaking, and I'm going to caveat this by saying I am not a not-for-profit expert, but I do understand the issues associated with CRTs and unrelated business income tax and the pretty punitive taxes associated with that. And so the short answer is yes, a C corporation or a Ric MLP fund should block any unrelated business income tax from creating any problems with the charitable remainder trust.
Okay, great. Thank you for that. Now, to keep you in this discussion here, Greg, or Justin, if you want to jump right in, we do have a question that's probably more in the Global X wheelhouse here. At the outset, Greg, you talked about midstream MLPs were quantified as about 45% of the market in that pie chart that you showed us. Is there an expectation that that portion of the marketplace is going to be growing vibrantly in the coming years? What's the outlook there for the overall market?
Sure. I don't know that we have a strong view either way. I will say a couple of things. I think you're seeing the MLP structure being used for some of the other types of investments. So the other slices of the pie, if you will, are starting to explore additional ways to use the master limited partner structure. So that's one thing that it could actually imply that slice shrinking. And I guess the other thing that occurs to me is the Kinder Morgan transaction would take out a few of those in that sector. So that would actually shrink it down.
Okay, thank you. Now, getting into some quantification here, what is the volatility and long-term after-tax return on the average MLP ETF, looking at this in a longer-term perspective? I'm not sure if that's a Global X question or one for you, Rob.
I'll probably defer that to the Global X.
Yeah.
Broad brushstrokes here. I know you're getting into territory that you probably don't want to get too into, but just to, to give a general impression of what is the characteristic, broadly speaking, of this investment.
Right. So I think to the after-tax portion, as we just kind of learned, there's a lot of different permutations there. So the after-tax return is actually going to be very case-specific. I mean, broadly speaking, MLPs are an attractive asset class. They have a lower volatility than the market generally when you hold a diversified basket, and the yield helps there. I did see another question about interest rate sensitivity and so forth, and just kind of incorporating those thoughts here. The MLPs, generally speaking, do have sensitivity, being a rather high yield investment. However, that tends to be initial. So if there's a shock in rates, they tend to respond in kind. But on a long-term basis, there is not a whole lot of evidence that there's as much of a correlation there. And I think that's probably due to fundamentally the underlying businesses that they're involved with, the toll road business model, if you will, the growth in the energy business just in general. So short-term, yes, sensitivity to interest rates. Longer-term, not as much.
Okay, thank you, Greg. That is about all the time we have. As I said a moment ago, we'll get these questions answered. There are a number of them that have been left on the table, and they've all been really good. On that note, that concludes our Expert Series webinar on MLP taxation. Know your options. Greg and Rob, thank you very much. I want to thank the audience also for attending and for all the interesting questions. I don't know if I said this earlier. The presentation will be available to all of you in 24 to 48 hours. You'll all receive instructions on how to obtain it in an email. I think this is quite a good deck, a lot of details to chew on for sure. On that note, on behalf of my guests, as well as all my colleagues here at ETF.com, I'm Ollie Ludwig, wishing you all a very pleasant afternoon.